Hey everyone, welcome to our financing for real estate webinar. Before we get started, I wanted to do some quick housekeeping. Please, if you can type into the chat box to let us know that you can hear us loud and clear, that'd be super helpful. So we're gonna wait till we get a couple responses to make sure everybody can hear us loud and clear, and then we'll go ahead and get started. Okay, great. Looks like people can hear us loud and clear. Awesome. Well, thank you guys so much for being on the webinar this evening. This is going to be a really exciting topic to go over, as financing is such a critical part of the home buying process. And we have our amazing preferred lender, Reed Hazard from CMG Financial, to go over the ins and outs of the entire process. With rates being as record lows as like where they are now, we're seeing a huge surge of buyers. And that's for primary residence owners as well as for investment purchases. So Reed's going to go into a little bit more detail about some of the options you guys have, as well as some of the data points on the current mortgage market. Okay, before we get started, I want to just introduce myself quickly. My name is Vince Tomich. I am an advisor here at Marshall Reddick. And my primary role as an advisor is to learn as much as I can about each individual investor and help guide you through the investment process and eventually achieve your investment goals. So a little bit more about myself is I was born and raised here in Southern California. I've been in the real estate industry for over 5 years now, and I am a property owner myself. And prior to the role I'm in now, I was actually doing loans. So that's where I really learned and was given the confidence to move forward with investment purchases. Once you understand how financing works, how leverage works, and you realize that with that, you are able to, make a purchase, whether it's here locally or in one of our out-of-state markets. It gives you that much more confidence and encouragement to move forward. So really excited to be going over that topic specifically now with Reed. Now, before we turn it over to Reed, really quickly, I see that there's quite a few folks on here that have probably been to webinars or events in the past, but I do see some new names. So I like to take this opportunity to explain who Marshall Reddick is and what we do. So Marshall Reddick, I would describe Marshall Reddick as a full service real estate firm, and we focus on 3 primary services. 1 being brokerage, 2 is property management, and 3 is private lending. So for our real estate brokerage, we help folks buy and sell, whether it's their primary residence or investment property. That could be here in Southern California, where our headquarters is located, or in one of our many markets across the country. Most of the folks that buy investment property are going to need property management. So we would handle everything from A to Z in that aspect. Everything from marketing the property, doing the showings, background checks, rent collection, rent disbursement, any repair items, move out inspections, and basically anything that an owner would have to deal with the property, we would be able to take that over on your behalf. Our final service is private financing. So there's actually 2 clients there. There's borrowers and lenders. And this is very different than conventional financing, which is what Reed is going to be covering today. Now, private financing are for the folks that typically can't obtain conventional financing. So to give you some examples, those borrowers may be folks that are looking to do a fix and flip on a house for more of like a construction type of loan. Or some of the long-term borrowers may be the folks that are looking to leverage their self-directed retirement accounts and they want to buy property. And if they don't have enough money within those accounts to buy the property cash, they need leverage. And that's where the private financing could come in. Now, as I mentioned earlier, that's 1/2 of our clients for private financing. The other half are lenders. So the same way that we can help you invest in property, we can actually help you invest in mortgages. Those would be first position mortgages, and those rates of return go anywhere from 6 to 12%. So if there's any interest in any of those services, that is something that I can help with directly and help navigate you and get you in touch with the right people. So without further ado, I'm really excited to bring in Reed Haswood. Reed's been working with us for over 15 years, has a wealth of knowledge, does pretty much all of our business. So I'm really excited to have him on and go over this process. So Reed, take it away whenever you're ready.
Awesome, Vince. Thanks so much for having me. And yeah, I mean, great to be on the call, you guys. This has been such an interesting year. And, I mean, interesting would probably be an understatement, but I hope everybody on the call is safe. Any of you guys that are dealing with COVID, obviously hope that all is okay there. My mother and father actually recently got it, but they did make it through, thank God. So I just hope that everybody on the call is safe and everybody is doing well, and very, very happy to be here today. This is actually the first seminar that I put on personally since the COVID-19 update that we did, I think was right in March. So if anybody wants to go online and check out that webinar, we did that back in March of this year. And a lot of that info that we explained actually coincided into really kind of what happened. So definitely check that one out if you guys have time. And yeah, so here tonight to talk about financing for buying a primary residence or an investment property in 2020. A little bit about myself. I've been doing this now for over 15 years. I live here in San Clemente, California, in Orange County with my wife and with my 2 children. And yeah, I've been, this is really my specialty. I started out as an investor when I was 19. I own multiple properties in multiple states. They're all managed by Marshall Reddick. And yeah, I've done very, very well here. So happy to be here tonight to talk to you guys about financing. There have been some changes since COVID-19, so we're going to kind of be covering those. And then obviously what the current guidelines look like today. And let's get here to the next slide. So the information I'm going to be covering tonight is getting pre-approved. What does a pre-approval consist of? How this will give you an edge on the purchase market, really the best programs that are available for a primary residence or an investment property. We're going to go over conventional, we're going to go over FHA, VA, jumbo loan programs, and then what's really happened since COVID-19. What are those guideline changes that are specifically going to affect you? We're also going to be going over some private financing options. So if you want to purchase out of a self-directed IRA account, or if you want to buy with an LLC, or if you just can't qualify for conventional financing, Marshall Reddick has some amazing programs that they put together. So we're going to be going over those as well. And then we're just going to do a short market update. I just kind of want to give everybody an update for what to expect here over the next 12 months. I've got a pretty good gauge on things, so we'll go over that as well. Okay, so just a really general overview, guys. What is getting pre-approved? There's 2 things. There's one's getting pre-qualified, one's getting pre-approved. So getting pre-qualified is really just having your credit ran or doing a soft pull and filling out a loan application. If you're a W-2 client and let's say you make a couple $100,000 a year, you have no debt, or maybe you own a primary residence and your payments $4,000 a month, you're going to be a pretty simple client to approve. So, maybe you can do just a loan application to get your credit ran and have a good idea that you do qualify. But for many of us out there, it's a bit more complex. And especially in this market, to give you an edge, getting pre-approved is really the way to go. And it's free, it doesn't cost you anything. We're just like a real estate agent where we don't get paid until the deal closes. So everything's complimentary up until then. And so I really want to kind of go over getting pre-approved. This is the right way to do things right now if you're serious, and if you want to be able to place an offer to close quickly. It's a very, very competitive market right now. So the required tasks for getting approved, you're going to complete a loan application. We're going to run your guys' credit. We're actually going to do a DU approval, desktop underwritten approval with Fannie Mae or Freddie Mac. Or if you're a vet and you're going to buy a home to live in, we'll do a VA AUS approval. But the point of this is that we're going to get you an actual loan number, and then we're going to get all the documentation that's on that approval, and we're going to source it, and we're going to get everything on file. This would demonstrate getting a full loan app and full set of documents to the lender. And then what we do that's a little different is I have multiple underwriters. The underwriter is the person that makes a decision on the loan. So most banks, they don't do underwriting up front. It's very costly. But I like to say that it's a lot more costly if you don't pre-approve a file by an underwriter and then it blows up later. That's a lot more costly to me. So this is our insurance policy for you and for us and for the realtor and for all the partners that are involved. So we will actually have David Van Vuren is my pre-underwriter. He will pre-underwrite your file. He looks at every file, whether you're that W-2 client that owns no other properties with $200,000 a year and simple assets, or you're the client that has 9 investment properties and self-employed. The loan's always going to go through underwriting here, and that just allows us to confirm the accuracy of your file and to give you guys a true pre-approval. So it takes a little bit of time. We're usually taking 24 to 48 hours to get a pre-approval done. If it's Friday evening and you guys are going to look at property over the weekend, and you guys have got to get that done ahead of time, depending on the complexity of your file, we should be able to get it done. And in some cases, we may just do that pre-qualification because you are such a clean borrower and you need to get that letter fast. Although that's not how we like to do it. We really like to get as prepared as possible. But again, it's usually about a 24 to 48 hour waiting time. Then we get you guys an approval letter, get you some numbers for review, and then we are licensed in all the Marshall Reddick markets, and my company CMG is licensed in all 50 states. So I'll be able to help you in any of the Marshall Reddick markets. I am the loan officer on the transaction. We don't pass you off. Whether you're writing an offer with Terry Duffy in Florida, and then now you want to write an offer with Christina Doriot in San Antonio, I would handle both those. So those both will be done here. And Christina's our preferred realtor with Marshall Reddick in San Antonio, and Terry Duffy's our preferred realtor out in Florida, in case any of you don't know who they are. But so my firm also works, my firm, but also my specific team works with all the realtors within Marshall Reddick in their different markets. So very, very tight group. And again, you will not be passed off. You'll be working with me and with my team. So this would represent a loan pre-approval. They're generally good for, credit was good for 120 days, but with COVID, really depending on your file, we may need to rerun credit within 60 days. So just know that ahead of time. So some other reasons why it's obviously important is that sellers are not going to consider you a legitimate buyer if you've not taken the time to officially become pre-approved with a lender. If you go on Rocket Mortgage and you get one of those pre-quals printed out and you submit that in this market, unless you're putting 50% down and you've got proof of funds, it's just not going to hold any weight. You're in a multiple offer situation on most properties right now, especially if they're priced competitively. So you definitely want to be approved. Something that we do is I reach out to the listing side, let them know obviously that you're fully approved. I don't divulge too much of your information, of course, but I do obviously let them know that that if you're W-2, that you're W-2, that it's a very clean approval, that we already have a loan approval on file. I leave it up to you and to the agent to discuss if you can go higher. So we never go over that with the seller side. But making that extra touch call is very important. Me and my team have over 100 5-star reviews online with Zillow and some of the other sites. And I was ranked number 64 in the nation out of about 1 million loan officers in 2018. And I'm consistently ranked in the top 100 in the nation each year. So I have a lot of credentials and things that I can point to that will really back up your guys' loan approval. So things like that can help you to win a deal. And it's just, especially in this environment, you really got to get pre-approved. Now, if you're self-employed, even if your business has been growing through COVID-19, it's extremely important to get approved up front. Don't let somebody just write you guys a letter to make you feel good and then think that that was the right way to go without you supplying any documentation. It's everybody's obligation on my end nowadays to definitely make sure if you're a lender that you're getting your client approved so nothing blows up later. Again, just an example of what some lenders do is they just do an application and they run your guys' credit. And it just does not prepare you for a good transaction. You're also having to jump through way too many hoops during what I would consider to be, a stressful situation. You guys are buying a home. You guys are going to work. Many of us are working from home. Many of us have kids. it can be stressful. So we want to get you guys as prepared as possible to make this smooth, not only to close on time, but to make it a good transaction. Just some commonly asked questions is how long is the approval good for? It's generally good for 120 days. We'll always ask for updated pay stubs and bank statements, usually every 60 days. But the credit should be good for 120 days. In some cases, we will have to run it again after 60, and we'll let you know that when we get you guys approved. Another question is, what if I'm not looking to buy for 4 to 6 months? Is this really something where we have to run the credit? Again, it just goes back to me doing my job and asking the right questions and getting a full loan application and getting all your documents. If it's a complex loan file in any way, if you have multiple investment properties, we just have to run your guys' credit in order to really issue that loan approval. If you just want to do a pre-qualification where we don't run a hard inquiry and we get a loan application and you have a very simple file, then we are happy to do that for you. But that's not going to be a loan pre-approval. That's going to be a pre-qual. And I don't advise doing that unless, again, you fit into this very organized box of that it's just a very simple loan, and we'll be able to tell you that up front. Again, if you're just planning, we do a lot of mortgage planning here within Marshall Reddick especially. We have buyers that have been, preparing to buy for 2 years, and then we help them. We have other buyers that are ready to buy a property, tonight. So depending on where you're at in your home buying process, we're here to help, and we're not here to pressure you. So this is based on, your guys' goals and how fast that you guys want to move. It takes, like I said, 24 to 48 hours to get approved. And also, let's say that you're doing a 1031 tax deferred exchange, you're going to sell one property and you're going to take your equity and move that into multiple properties. I have buyers right now that we're doing 4 at a time, so we specialize in that. Most banks are not willing to do investment property financing right now. The loans are difficult. You've got the foreclosure moratorium going on. Moratorium. And with that, many lenders have backed out of doing investment property financing. My company, CMG, specializes in it. We're also the loan servicer. And we're in a position where we're actually trying to grow our servicing book right now. So we are looking for investor loans. So many are not. And so if you want to buy more than one home at once, we are the company and the team that can help you do that.
Awesome, Reed.
Okay.
We're going to do I'll jump in and we'll do a quick poll for everybody just to kind of get a gauge in terms of where some investors are and other homeowners. So we'll go ahead and get that going. What does your current real estate portfolio look like? So we'll give you guys a minute or so to get this filled out. We're not going to be sharing not going to be sharing names, but we'll go over the results. So go ahead and take a moment to fill that out when you have a. All right, we're going to give it another 10 seconds or so. Awesome. Thank you guys so much for your participation. We're going to go ahead and close that up, and we'll see what the results look like. Great. So looks like there's a good chunk of folks that have not purchased yet. So this is going to be super helpful, this information, and then spread evenly amongst the rest between 1 to 10 plus units. So 2 to 4 and 5 to 10 seem to be the bulk. So awesome, great info. We're going to turn it back over to Reed so that we can go over the rest of the presentation in a bit more detail.
Awesome. Thanks, Vince. So we've talked about the pre-approval. Now I want to just kind of go over how do we qualify you. And this is the way it's been since around 2009, when the stated income, stated asset loans and no documentation loans, when you could fog a mirror and buy 10 investment properties, went away. So it went back to the traditional way of financing, which is making sure that the borrower's debt to income ratio is low enough that they can afford the property based on government guidelines. So debt to income ratio, what does this mean? So if you make $10,000 a month, let's say that you're W-2 and that you make $10,000 a month, that you have $120,000 a year salary. Let's say that the monthly payments for the home that you live in, let's say that you rent, or let's say that you own, either way, but that payment with principal, interest, taxes, and insurance is $4,000 a month. No, not counting any utilities, but just those fixed expenses. Let's say it's $4,000 a month. And let's say you have no auto loans, you have no minimum payments on credit cards, and so your total debt's $4,000 a month based on what's on your credit. $4,000 divided into $10,000 would be 40%. You'd have a 40% debt to income ratio. Now let's say that you did have an auto loan that was $500 a month. Okay, so $4,500 divided into $10,000, you'd have a 45% debt to income ratio. The debts that are included in your debt to income ratio are auto loans, mortgages, including the taxes and insurance, if there's any HOA on there, student loans, any other loan that's on credit. Debts that are not included, okay, auto or health insurance, cell phone and utilities, loans to family and friends that are not recorded, business loans, what you would pay your gardener, things like that are just not included in debt to income. So now that we know debt to income ratios, what are the max debt to income ratios currently during COVID for buying an investment property? And believe it or not, they're still the same that they were before, 49.99% max. And how we know if you can get to that max amount is when we do that desktop underwritten approval with Fannie Mae, which we need your guys' credit to do. This is a lot of the reason why you need to get a hard inquiry and need to actually do a hard pull and do a full credit approval, is so we can get the exact approval from Fannie Mae. Because if you're 46% and you've never owned real estate before, but everything else checks all the boxes, Fannie Mae might not want to accept it. And this is an automated system, and it quantifies the results. But again, to get the actual approval, it's got to go through Fannie Mae. That's how we get the loan number. And it will approve it up to 50% still, which is great. You guys can see there as your FICO scores. This is based off your middle score. So we each have 3 credit scores, one with TransUnion, one with Equifax, one with Experian. And for mortgage lending, we go off of the middle score between the 3. If you buy a car, it's usually only 1 score. So if the middle score is lower, you'll see that you're going to get capped in Fannie Mae's system at a lower debt to income ratio. Anything above a 740 mid score is A+ credit for buying an investment property. It's also A+ credit for a conventional mortgage loan. Any loan above $765,000 is considered jumbo, and on jumbo loans, there's a credit score tier for 760 and above, 780 and above, and even 800 and above. You'll get a little bit better pricing. But on conventional loans, again, it's 740 mid-score. Okay? So we're going to go over conventional loan programs first. Conventional really refers to Fannie Mae, Freddie Mac, right? So that's the government purchased those companies through the TARP funds, which was back in around 2010, and basically, they funded those companies and kept them alive, and they've been using those companies to basically buy up pretty much every mortgage-backed security, which is a bundle of loans or mortgage bonds. They've been using Fannie and Freddie to purchase mortgage loans through quantitative easing that we had, right, to keep rates low. Really to buy up all the bad debt that had been issued through the last recession before the one that we just had over COVID. So they've been, using Fannie and Freddie now for years, and this loan amount was actually capped at $417,000 nationwide. And about 5 years ago, they started to raise that amount every year. And why they raised it is because we started to see some inflation again in wages. It's plain and simple. And unemployment went from, 10% in 2010 down to 3.4% in 2019. So as the unemployment rates got better and as there started to be wage inflation added back into the market, Fannie Mae and Freddie Mac raised the loan limits, right, to support higher prices. So in Orange County and in the Bay Area and in Los Angeles County, for example, and some other high-cost markets across the U.S., Fannie Mae and Freddie Mac will lend to a max loan amount on a one-unit property of $765,600. In most states, it's capped at $510,400. And that was what used to be that 417 loan amount for years and years. It's been raised over time to 510, 400. So why do we look at conventional financing? It's, for one, it's the best interest rates if you have higher credit. I consider anybody that's really above a 700 mid score, you're going to find that conventional is going to have the best deal. Really, it's got the best loan programs for investment property financing. You can't use an FHA or a VA loan to buy an investment property. It's really the only loan out there with these types of rates. And if you can't qualify conventionally, you're usually looking at a private option, which Marshall Reddick can help you with. It also provides minimum down payment options on a primary residence. So the 3% down primary residence loan was actually not really being utilized for a while, and we didn't even have it available there for a little bit. Now it's actually back, which is surprising even during COVID. So we're starting to do a lot more 3% down again. The rates are just so low right now that it makes a lot of sense. The mortgage insurance will be very high on that product if your FICO scores are not at least 720 plus. So we look at that kind of case by case. Usually you'll find 5% down is really the, kind of the sweet spot if you want to go minimum down on a conventional loan. And then of course, if your credit scores are on the lower end, you're going to want to look at an FHA loan if you're going to want to go minimum down. And I'm going to cover that on my next slide. But so again, really for low down payment and for better credit score borrowers, it's just the best way to go. Lower mortgage insurance costs with less than 20% down. So the FHA mortgage insurance, the monthly MI, is 0.85 of 1% of your loan amount divided over 12 months. If you put 5% down on a conventional loan and your FICO scores are 740 plus, you're about 0.38 of 1% of the loan amount divided over 12 months, so about half. Also, there's no mandatory points on conventional loans. Points refer to paying a percentage of your loan amount. So 1 point would be 1% of your loan amount. On an FHA loan, there's 1.75 points or 1.75% of your loan amount that's built into the new loan. Whereas on this loan program, there would be no points. Also, you can do loan amounts to around 1.5 million on a 1 to 4 unit property using this type of product, which is just phenomenal. So I'm going to cover that also on another slide here in a minute. So here are the max loan amounts for Fannie Mae and Freddie Mac based on the high cost markets for 2020. So like I said, New York City, Los Angeles County, really where it's the higher cost market, Fannie Mae will go higher. So as you guys can see, you can do up to a $1.472 million loan amount. Let's say if it's Los Angeles and you guys want to buy a duplex and live in one side, you can go 20% down and buy up to $1.472 million loan amount and get a really, really great rate. So it's just phenomenal financing. For many years, like I said, they were capped a lot lower than this. And so now to see that you can get $1.5 million worth of Fannie Mae money is pretty exciting to me. And again, it's capped at 1 unit is $765,600, 2 units. So to correct myself, really you can go to a $980,325 loan amount on a 2 unit. If you wanted to do a 3 unit, 1.184 million, and then a 4 unit, you'd be capped at 1.472. But you can go 20% down on the 3 unit and 4 unit now. You used to have to put 25% down on a primary. You now can actually do 20% down on a 3 and 4 unit, which is pretty cool, even on this high cost loan, or excuse me, on the higher loan balance loan. On the 2 unit, you can do as little as 15% down. So let's get into the guidelines that have changed since COVID-19. So rental income updates. You must now show and verify your income from your tenants and show that it's been consistent through COVID with no payments missed. Now, we used to just look at the tax returns, and if there's income on the tax returns already, we didn't even need lease agreements. We just go off an average on the tax returns. And now we have to literally verify bank statements for the past 60 days, and we have to show that that income is coming in, okay? And if there's been any gaps during COVID, or if there's been any gaps in the last 60 days, then they're going to want to see, bank statements for the whole year. And if there was any gaps at all, then you're not going to be able to use that income. You're also going to have to get a year-to-date profit and loss statement for a business. So if you guys are self-employed, or if you're W-2, but you also have a self-employed, you have a Schedule C, or there's a different business there that you guys own, you got to get a year-to-date profit and loss statement. You also have to show that the income is in line with 2019. So you can't show any declining income for this year versus 2019 income. You also have to get bank statements, and the bank statements have to coincide with the P&L, so with the profit and loss statement. So if you send us a profit and loss statement that shows that you have higher income this year, and then we get the bank statements and it's not adding up, then it's going to be a deny. So it's really gotten a lot more difficult for self-employed borrowers, and then also if you're using rental income. Self-employed borrowers must show there's no declining income from 2019 versus 18. So we need to show that in 2019 that you made more money than 2018, or at least that it's very similar. If there's a small amount of declining income, I mean a very small amount, and then we can show that this year that you have higher income than 2019, then we can usually make that work. Whereas before, we just take a 2-year average, and if the income was declining on the business, and we could explain why, and then get a year-to-date P&L showing that it was healthy, we'd be fine right away. Now, if there's declining income, it's impossible to get it through. The verification of employment is done now 4 times throughout the process. So if you lose your job while we're in this process, God forbid, if you lose your job, they're more than likely, we're gonna find out, because we've got to verify the employment 3 times moving into the end of the process, and then at the end of the process, there's also going to be a verbal verification of employment done. Now, if any of you are worried about, your employer knowing that you're buying a property, or you want that privacy, just know we've always had to verify employment. It's done through your HR department. It doesn't go to the CEO of your company. They're not checking that stuff. It's a very private thing, but lenders have always had to verify employment. So nothing's changed there. It's just, we used to only have to do it 1 time and then do a verbal at the end. And now again, it's done 4 times. So clearly Fannie Mae and Freddie Mac are, they know what's going on in the economy and in certain sectors, and they want to make sure that you guys are employed when we close. Now, what if something happens and you were to lose your job right after you close? Well, the loan's done. So we're not going to come and, ask for you to send us back the money. Once the deal is recorded and it's done, it's done. But yeah, just be aware of that. There's a lot more checks and balances going on right now. If you're a Schedule C and not incorporated, so if you're self-employed, but you don't have, you don't have an actual corporation built, you need to have a 5-year history now in that line of work. Whereas before, we just would show that you had that Schedule C income for 24 months. We take a 24-month average, and we were good to go. Now you got to show a 5-year history. The debt-to-income ratio requirements that I went over earlier, for W-2 borrowers, it's the same. You're capped at 49.99% on a conventional loan. If you're self-employed and it's a conventional loan where the loan amount is below $765,600 in a high-cost market and below $510,400 in a standard market, then it's going to be capped at 45% if you're self-employed. Investment property financing now requires 20% down minimum. So there was a 15% down Fannie Mae investor loan available for about 5 years. That loan is no longer available. You must put 20% down. This is also another guideline that was updated, is you must have 12 months of reserves, meaning when you go to buy a property, if you're putting 20% down plus your closing costs, when that deal is done, how much money are you going to have left in the bank that we can verify? That's your reserves, right? And so when we say 12 months reserves, we want to see that you have 12 months of monthly payments for principal, interest, taxes, insurance, and any HOA on the property, that you have that amount of money in your savings when you close. And that's for buying an investment property. If you're buying a primary residence, Depending on your credit score and the Fannie Mae approval, we can still get you approved with no reserves at all needed. Okay, so that's only on an investment property. But the 12 months is also only for first-time investment property buyers. So if you already own a property, we can usually get Fannie, even if it's a primary residence actually, we can still usually get Fannie Mae to approve only needing 6 months of reserves, which has always been the standard before COVID, is 6 months. But if it's your first time buying a property ever and you're buying an investment first, which many of us do. I bought my first property I bought in Altamont Springs, Florida when I was 19. It was an investment property. You know, it wasn't a primary residence. It's actually how I started building my wealth, is buying investment properties first. So many of us start that way. And just know that now, you know, while we're still in the heat of COVID, Fannie Mae is now requiring 12 months. So this is a big change, you know, for anybody that's got, you know, trying to get 50 grand put together for their first property with down payment and closing. That extra 6 months of reserves means you probably need to have an extra, you know, $10,000 or so in savings now to buy. So that's a pretty big change. So I want to jump into VA loans for a primary residence. We're going to talk a little bit about primary residence financing now, mainly. For a couple slides. So VA loans, if you're a vet, if you served our country, you know, you should definitely get the best loan out there. And really, VA loans are just phenomenal. The interest rates are generally a little bit below any rate out there. You can do 100% financing with no monthly mortgage insurance. There is a VA funding fee that VA charges that's built into your new loan. So it's going to cost a couple % of your loan amount, depending on if you've already used your VA before, if it's your first time using it. If you're a disabled vet, there's no VA funding fee. And this is something that we would cover on a pre-approval. But again, 100% financing, no mortgage insurance, primary residence only. You can go to a max debt to income ratio of 56.99%. So you can go quite a bit higher than on a conventional loan. W-2 or self-employed is fine. If you're, you know, no longer working in the military, that's fine. You just have to have that eligibility. That you were a vet. And then what's changed recently is there's no longer a cap on the max loan amount offered through VA. So I live pretty close to a military base down here in San Clemente. And we have quite a few, people that did serve in the military that have gone on to different jobs, or maybe they make, they're in a really high paying job for the military still. And, they're trying to buy a $1.5 million home. Well, we're able to do loan amounts that high now with zero down on a VA loan. So this is a phenomenal product. It's a pretty recent change, and definitely good to know. FHA financing. So this is great for first-time home buyers or borrowers that do have challenged credit, especially if you're going like minimum down payment. If you have a 680 mid credit score and you're trying to go with a 5% down loan, you're going to find that the monthly mortgage insurance costs are a bit lower actually going with an FHA loan than if you were to go with a conventional loan. The interest rate is also going to be quite a bit lower with that type of FICO score. Really, when you go down below 680, though, is when I say no matter what, FHA would be the better product. Depending on down payment and whatnot, 680 plus on a conventional loan might still make more sense to go conventional. But really, if you're in that 660 range or 650 or 640, which is still a great credit score. If you're down that low, though, and, say you want to go 3.5% down, FHA is going to be the way to go. Primary residence only. So there's no investment properties or second homes on FHA financing, no matter what you hear. It doesn't exist. And then if you had a short sale or a foreclosure in the recent past, this is the best program to go with. If it was within the past 4 years, you have to wait 7 years on a conventional loan before you can get a Fannie Mae, Freddie Mac conventional loan. If you had a foreclosure, you have to wait 4 years on a conventional loan if you had a short sale in the past. So anybody that's looking to get back into the market, FHA would definitely be the best way to go if you have either of those, and it was in the recent past. It's great for a 3.5% down loan product, like I said. And then duplex financing, you can buy a 2 to 4 unit property using FHA. Duplex financing is really where it shines the most because you can do 3.5% down on a duplex whereas conventional is going to require a minimum of 15% down. So even if you have great credit and you're trying to buy, though, a $800,000 duplex, you know, or even a $900,000 duplex, right, and you want to go 3.5% down and you don't want to have to put 15% down, you can do that as long as your debt-to-income ratio is qualifying. You can do it on a 2-unit property. So we do that loan quite a bit. I probably close one of those every other month or so. So it's actually a pretty popular loan product. Also, FHA financing, there's still some firms that I think will go down to a 580 mid credit score. I know when we had the flight to cash that happened around March, April, where, you know, there were margin calls happening everywhere, and, you know, everybody, the entire economy, even the government, was very worried about liquidity. I know at that point nobody was doing FHA down below 620, but I think there's probably some firms now that will go lower than that. Our firm is capped at a 620 minimum FICO score for any of our loan products. Okay, now jumbo financing. So this is any loan amount over 765, 600. There is nobody that I know of right now that's doing jumbo loans on investment property. I believe it could still be out there. I know it's a product that we're looking at getting back on board. But frankly, none of the biggest banks that we're able to sell our loans to, like Chase. I mean, CMG is a massive company. We'll fund about, I think we'll do about $30 billion this year as a company. Well, that puts us in the top 10 or so biggest lenders in the nation. But there's banks like, Chase that are doing that almost a month, right? So, you know, where are we doing our jumbo loans? Where are we selling those loans? Because we don't portfolio those loans. Really nobody does, except for the biggest banks. So we're selling those loans, right? The banks like Chase. We get a better rate than what they give you on the retail side. So that's kind of the niche that I can provide. Also, obviously, the service that we provide and being able to close on purchase jumbo loans quickly. That's why you would use us. Another thing to point out is we do a lot of jumbo refinance loans, and we do those with rates that I'm noticing are a lot better than Wells Fargo and Chase and BOFA. And that's because we're funding those loans. And if we don't fund them correctly, we have to buy them back from Chase, right? And we're funding sometimes $200 million a month or so in these loans. So we get a much better price than you going to a big bank and doing one loan at a time. And again, on those loans, though, those have become harder to qualify for. You could still do it with the 700 middle FICO score. You need to have 12 months of reserves. Okay, that was available with only 6 months before. So the highlighted line items on your screen, this is what's changed since COVID. So before COVID, you could get a jumbo loan with only 6 months reserves. Okay, now it's 12 months minimum. Debt-to-income ratios are still capped at the same, 43% max debt-to-income ratio if you're a W-2 borrower. If you're a self-employed borrower, they've lowered that down to 35% max debt-to-income ratio. So even if your business is growing dramatically and we can show much higher income year-to-date on a profit and loss versus last year, it's still going to be capped at 35% no matter what. This was more of an industry-wide guideline for prime jumbo. You could still do a jumbo loan for a non-prime product and go to actually a max of 50% debt-to-income ratio, but those rates are going to be in the 5% range. This is for the type of financing that has rates similar to the Fannie Mae, Freddie Mac loans. We were in the high 2s or so. And so again, for these types of loans, 35% now they've lowered that down to. I'm really hoping that they bring that back up again because there's just so many great self-employed borrowers out there that have very stable companies right now. And unfortunately, there's just nothing we can do on that guideline for now. So I think once the foreclosure moratorium eases up and things change in that regard and we get through maybe mid-year next year, you're going to see that have to change because banks need to originate loans of this size. But again, right now it's just not available. And then 20% down is now required. And we were doing even 10% down jumbo with no MI and selling them to Chase back in like February, So that and it's just not available anymore. And I have people still that have come to me maybe a few months ago and said, "Oh, I still got to prove it 15% down at both." And then they went back and now they're no longer doing it. And now they're really not doing it. So just be prepared to put 20% down if you're going to go jumbo, and be prepared to have those 12 months of reserves. This is a fun picture. I thought I'd throw this in there. This is me when I was 19, working with Marshall Reddick. So that's when I worked for American Direct Mortgage. I'm almost, 35 now. So yeah, that's back when I had no kids and didn't have a beard, and it was a lot of fun. I remember I've really had a passion for what I do for really forever. If you've worked with me, you would definitely know that. But yeah, that's me back when I was 19, and that was a Marshall Reddick seminar. So this is definitely how I got started, was within Marshall Reddick. I was an intern, and I got a job at American Direct Mortgage, which was one of the 5 lenders at the time. They were preferred lenders through Marshall Reddick at that point. I was their director of marketing. I'd go and speak on loan programs at about 18 different club meetings, what they were called. We used to have club meetings where we'd fly in different areas all over the country to present their properties, and lenders would go, and Marshall would speak on different education topics. And anyways, it was a lot of fun, and that's how I got started. So this is when I started working for American Direct Mortgage and started doing loans. Okay, so very important note I need everybody to be aware of, okay, because forbearance looks kind of tempting when the news and everybody's telling you that you can skip your payments and there's going to be no effect whatsoever. That is just not the case, and you need to know this because you could really put yourself in a bad position for the future. So if you participate in forbearance, and I don't want to steer anybody away from it, because if you need to do forbearance, you need to do it, and you know, the government says you can do it, and it's in effect. But I want you to be aware of the potential effects that will happen later. So if you do forbearance, it's likely that you may not be able to buy. It's not a fact yet, but I believe that they're going to make it similar to what's called a loan modification. Remember any of you guys that know anybody or that did a modification back in the day, maybe in 2015, right, or 16, where you had a loan that was from 2008, you know, that had a really high interest rate. It was owned by Fannie Mae or Freddie Mac, and you were able to do a DU refi plus refi, and maybe you weren't able to do it, and they ended up denying you, so then you ended up doing an actual loan modification where the bank modified your terms. If you did that, you were not able to buy using conventional financing or refinance a conventional loan for 5 years. So what happens when you do a forbearance is, how we know you're in forbearance is when we run your credit on our end, it will show that there's no payment due. So it won't show that it won't show like that it's late. It'll just say that there's no payment due. Then after the forbearance period is up, once it's finished, then it's going to show on your credit that you did participate in forbearance. I believe that once the forbearance is completed and it's fully done, I don't know that there's a way to get out of it. I think it's going to stay there on your credit. I have not personally ran into the situation just yet. Everybody that I've worked with so far, they're generally still in it. They might be 2 months into it or whatnot, and then they go, oh, okay, yeah, I'm going to get that changed. Because we cannot get your loan done on a conventional loan if you are in forbearance. FHA and VA, it's a little bit different, but it will affect your ability to get a conventional loan. I believe it's going to be probably to the tune of 5 years. I think that banks are going to treat it this way, especially when we're out of this. Even if you could show that you had, a bunch of money and that you didn't need to do forbearance, I think it's going to be treated this way. So just know, in order to get a conventional loan right now, you would need to be out of forbearance in order to qualify. And I do believe that they're probably going to treat it just like a loan modification. Every lender will be a little bit different with it, but this is kind of what we're being told in the industry right now from everybody that's above. So definitely be aware of that. How do I remove a forbearance? You just contact your loan servicer and request that the forbearance is to be canceled and paid back in full. And then they will go in and they will update your account and they'll show it back to normal. And they'll actually show the payments that have actually been made, right? Because you're going to have to pay it all back. So it'll show everything current to date. Just a quick little overview on how to close your loan faster, so that we don't really run into any headwinds after we start the process. This is mainly during a purchase or refinance. So once we start your purchase or your refinance, Don't go out and open new credit of any kind without talking to your loan officer first. Don't max out or overcharge on your current credit cards. In some cases, we're going to ask you not to use them at all. Maybe your debt ratios are very tight, and by adding a minimum payment on your credit card, you throw yourself over the 50% debt ratio limit. So try not to use credit cards at all or very little. Don't go out there and consolidate a bunch of credit card debt. If you change your assets, that might affect your ability to qualify. If you're going to make any large purchases, just let us know so that we can account for that. And then if you're going to go and put large deposits into your account and it's going to be used for the purpose of the loan, it always has to be sourced. So, if you're going to put $20,000 of cash into your account that you've been saving for a while, just know that if it can't be sourced, we're not going to be able to use it. Now, once a few months has gone by and that money's been in there, and maybe you send us your bank statements and we don't see any large deposits, that money's been seasoned, and then we can use it. But after you get approved, don't go and try to put your money in after the fact and go, I want to use this money now, right? Because it's got to be sourced. Do maintain employment at your current job. If you just got hired by Facebook and you're getting a job raise and you already have a contract for that job, keep your current job until you start the new job if you can. If you absolutely can't, you're getting a severance package, that's fine. We'll have to get a copy of the contract for Facebook, but you'll need to be on the job for a full 30 days. So we have 30 days of pay stubs. So try to just stay at your current employer forever during this process if you can, and then make a change after. Do keep all existing credit card accounts open. Don't close anything unless we tell you to. If there's any collections or judgments or tax liens that are reported within 1 year, we would tell you to pay those. Stay current on all existing accounts and financial documents. So always make your payments on time. If you were to be late on a mortgage, for example, 1 30-day late, it could drop your scores by about 100 points. And then contact me with any questions while you're in the process. If you have a concern, always call up your loan officer and ask that question before you do it. So the down payment requirements for investment properties. So I talked about earlier, 20% is now the minimum. If you're buying a 2 to 4 unit property, you've got to have 25% down. That has not changed. That has been the same guideline now forever. So that just has not changed. If you want to do a conventional loan, especially, it's got to be 25% down. Private financing offered through Marshall Reddick is, I believe, 35% down, which is really, really aggressive. And I love that because most private lenders are requiring quite a bit more, and they've got great terms. So if you can't qualify conventionally, definitely check on the website under the borrower tab, and you guys will be able to see what all their terms are. But yeah, for conventional financing, 25% down. As you guys see on there, you got a 660 mid-score. So for investment properties, you've got to have a 660 mid-score now. Used to be 640. And then you've got to have a middle FICO score of 700 plus to buy your 5th and 6th finance property. To buy your 7th through 10th finance property, you've got to have a 720 middle credit score. Also, these down payment requirements have actually been updated to we only need 25% down now and 20% down now when you go from 7 to 10. So 1 unit, you could still do 20% down and buy a 1 unit property for 7 to 10 financed. And 2 to 4 units for 7 to 10 finance, you could actually do 25% down. So it wouldn't require 30. So what do you need to know to get to 10 finance properties? So just to go over it again, really, you got to have a 700 mid FICO score to get 5 and 6, 720 to get 7 to 10. You got to have 6 months of principal, interest, taxes, and insurance and reserve for each property. If there's any HOAs, you'd add that on there as well. The rental income can still be used to offset your debt to income ratio. So for example, if the property rents for $1,000 a month, we can take $750 a month and add that onto your income. If your mortgage payment with taxes and insurance is $750 a month, that $750 we can give you an income would cancel that out against your debt ratios. That property would pay for itself essentially. So that rule is still intact, still good. Once a property, though, is on your tax returns, we're still going to have to verify your current lease and then 2 most recent bank statements to prove that you are receiving that income. If you're claiming a lot less on your taxes than your actual lease agreement, then we're going to have to go what's on the taxes, okay, unless there's a good reason for it. Maybe you were doing renovations for 3 months and then you got the property rented at the full amount. That's something that we might be able to get those rents increased. But as you start to acquire more properties, if your debt to income ratios are pretty tight as it is, very important to always claim all that rental income on your taxes so we can continue to use it to offset debt as you buy more property. So very, very important. Another thing that you need to know is 1 to 4 unit properties only. So anything above 4 properties is going to be considered commercial, and this type of financing would not count towards commercial properties, only 1 to 4 unit. You can have multiple loans, but can only have 10 financed properties. So, you could have 5 investment homes and 1 primary residence loan, and then have a home equity line tied to your primary residence, and that's not going to count as 7 loans. You're still only going to have 6 financed properties. Okay, and also the amount of doors, if it's a 4-unit property, that's still 1 financed property. Okay, so you could technically have 40 doors. You could have 10 fourplexes and qualify for this type of financing. This is available for purchase and refinance loans, and 15 to 30-year fixed available only. There is a 20-year product available for investment properties, which we do offer. And just some frequently asked questions. Again, yes, we can use 75% of the gross rental income towards qualifying. And then another thing, what if your property was already is not pre-leased at the time when we close on that property? It's very simple. We order a separate document with every appraisal on every investment property loan. It's called a 442. It's a rental comparable analysis. And we take maybe 5 properties that are just like the rental property that you're buying within maybe a 5-mile radius, and we take 75% of that average rent, and then we can add that onto your income towards qualifying.
Awesome, Reed. Great info. We're going to do our second and final poll question just to keep everybody engaged here. And so I'm going to go ahead and launch that. Which of the following appeal to you most? Buying a primary residence, buying an investment property, refinancing my primary or investment property, or other. So we're going to give everybody 20 30 seconds to fill this out, and then we'll show the results. So stand by. All right, awesome, guys. We're going to go ahead and share the results here. Okay, so for everybody, it looks like buying an investment property, which is awesome. That is the bulk of where everybody is, or where these loans can be applied to. Keep in mind, Reed can handle all of these scenarios, but it's good for us to get an indication of what you folks are primarily looking out for. So Reed, I'm going to go ahead and turn it back over to you to pick up where you left off.
Awesome. So I always love to show this chart because, my dad was buying property back in the early 80s. When interest rates on a 30-year fix hit 18.45%, that's when Paul Volcker pushed interest rates on the federal fund rate up as high as possible to slow down inflation. And why inflation ran rampant was really due to the oil crisis because of the Yom Kippur War and OPEC shutting off basically oil to the rest of the world. And if you guys want to learn more about that, specifically, I did a presentation on that that's on the Marshall Reddick website and my past presentations that I've done. It's very, very informative. But again, CDs at Bank of America or at a bank back then were paying 10% if you wanted to park your money in it, right? So it's all relative to its environment. But when you look at this trend line and you look at where rates are at today, you're at about a 2.625, 2.5% 30-year fixed loan on a purchase loan right now for a 30-year fix. So when you think about that, it's just I mean, I don't think that they ever would have gotten this low if something like COVID hadn't hit. But again, when you look at this trend line, it's just money is so cheap right now. So again, 18.45 to, depending on your scenario, definitely in the 2% range right now. So pretty phenomenal. So I want to go over this screen right here. So I'm going to help you guys understand what this is. This is the Fannie Mae 2.5% mortgage-backed security. It's the most closely traded mortgage bond, okay, which a mortgage bond may be a bundle of, let's say, $5 million of these types of loans that are bundled together and they're sold in the secondary market, right? And really they're transferred and sold. 50% of them are sold to the government, and then the other 50% of the market is other investors buying and selling these loans, big banks, right? But really they're doing what the government's doing, okay? That's why they're investing in these loans. So this is the 18-month chart for the mortgage-backed security for the 2.5. We've only been on the 2.5 for about, I think, maybe 12 months or so, maybe a little longer, 15 months. So it's not a full 18-month chart, but I'm going to dissect this for you. So each one of these little lines here, okay, candlesticks, is 1 day of trading, Monday through Friday, okay, excluding Sundays, Saturdays, and federal holidays. Green is investors. It could be the government. It could be other big banks. Green is investors buying the bond, causing the bond to appreciate, which drives down the yield and makes rates go down. So on one of these days when you had a green line, interest rates actually got better. So even though it's going up, the yield's going down. Rates are getting better. So think up is actually down. Red is investors selling the bond, causing the bond to depreciate, which drives up the yield and makes rates worse. So you could see around August of last year, and anybody that was refinancing around then, we were hitting like a low 3.30-year fixed. It was like, oh my God, rates just got so low. And a lot of that was just over, there was a lot of speculation that the economy could not continue to move up. The stock market could not go any higher. And as a result, there was a lot of money that was starting to hide in bonds. Really because everybody was kind of waiting for what's the next disaster that's going to be. And so interest rates got elevated to the best rates of really all time at that point. Then we worsened a bit, moved around, went into the new year, stock market hit all-time highs again. Money kind of came out of bonds again, and it was almost like we were starting to, maybe rates are going to start going up again like they did in 2018. Well, then in February, COVID hit, right? It started to become a big deal. So that first highlight that you see on the screen is where we were trading back when COVID started to become a big news line. But we were nowhere near shutdown yet, but it was starting to become a big deal. Now, I also want to point out these lines on the screen. These are your major trading averages. Purple line that you see is the 200-day moving average, the average where the rates have been for the past 200 days. Pink line is the 100-day. Dark blue line is the 50-day. The light blue line is the 25-day, and the green line, the light green, is the 10-day average. Okay, so as COVID started to become a bigger deal, we started to elevate, rates started to get lower. Then you'll see that we drove all the way up into the top of that first wick. And when we hit that wick is when rates hit the best levels of all time. What happened not too far after that is everybody got super scared. Everybody got scared. You started to see the stock market started to drop 2,000 points in a day. It was unlike anything I have ever seen before. Okay, and you started to see a flight to cash, a flight to liquidity, where big institutions were starting to sell everything. They were selling mortgage-backed securities. They were selling stocks, obviously. But they were selling anything to move into cash, okay, because we didn't know what was going to happen to the economy because they shut the economy down. Okay, and we didn't know for how long that was going to happen, and we didn't know what was going to happen with COVID, and we still don't know entirely, but now we have a lot better grip on things. The biggest problem, though, is that we didn't know, we didn't know if hospitals were going to get overwhelmed and there were enough ventilators to handle it. If everybody started getting sick, it got really, really scary there, and the government hadn't come out and lowered the federal fund rate to 0 yet. The federal fund rate was still around 1.25%. Okay, so what happened was, whereas all this money went into mortgage-backed securities when it wasn't quite as big of a deal and rates got to the best levels of all time, then all of a sudden it was like everybody's selling everything, including mortgage-backed securities, and the government didn't announce that they were going to step in quite yet. They didn't lower the federal fund rate to 0. So you actually saw rates go up a ton within about a week period. They went to the best levels of all time, went up a ton. Then this green line in between, that second highlight where you see that it went up again a bunch, meaning rates went down a bunch, that's the day that the Fed lowered, I think it was on a weekend, on like a Sunday even, where they lowered the federal fund rate to 0. So we woke up on Monday and, man, rates got a lot better again. Then they worsened a bunch, worsened more because it was still that flight to cash. The stock market was still plummeting. Several days I saw it go down, I think 2,400 points in a day. And that's when everybody was running to cash. Just didn't know what was going to happen. Then you saw us, move back down to this level of really the highest rates we had seen really over the past 12 months. It was right in that trend line. And then from there, as the government said that they were going to buy every mortgage-backed security that was written, that they would fully be investing into the economy, that they would come up with all these lending facilities to bail out businesses, you started to see a lot more confidence come into the market. Liquidity came back, and investors followed what the Fed had agreed to do. And that's why all this money went right back into bonds. And then we actually got to the best levels of all time. When you see us up in these ranges that we're at now, this is when we hit, rates up in the high 2s, really just phenomenal. Somebody on the last call that we did, one of the questions was, do you think that the 10-year note is going to go down, below 1%? And my answer was, I think it's highly unlikely, but it's possible. We went down to 0.38% on our 10-year note, so it did happen. And just pretty fascinating. So now what you've seen moving up into this highlight, this second to last highlight on the screen, this is when rates hit the best level, okay? When you see the news saying, oh, we just hit another new all-time low in rates, that's so that you pick up the phone and call them and call every lender around you to go and shop because you think that rates are the best they've been. They're not at the best levels quite right now. They're actually off by about 3/8 of a point. I'm going to show you on my next screen the exact day that they hit the lowest level of all time. Where we're at right now is where this last highlight is. Now, this is the 2.5% coupon. Where we're trading today is on the 2% coupon. Okay, so I'm going to show you where the rate was the best, really the best day. It was on August 3rd, and you'll see it. It's that first highlight. This is the best rate of all time that we ever had. This is when I was literally was able to do a 2.5 for a few people on a no-cost loan, even on a refi, okay? Purchase rates that day probably hit 2 3/8 with no lender fees, right? Then we bounced around, these next two highlights that I put on the screen are really sort of our floor of support. We've been keeping this line of support. Rates have not worsened below this level, and for many reasons, right? Which I'm going to get into in a minute. But again, that's the best rate of all time. So when you guys see the news and everybody telling you, oh, rates just hit another all-time low, just know that that's not the truth. It's so that you'll pick up the phone and call a lender and do a loan. That's the reason why. And those are paid for ads, by the way. Okay, now let's look at where we're trading today. Today was a great day actually for us, okay? We got some volatility in the stock market. It looks like, again, they're calling off any stimulus, which is really a bummer. They need to get stimulus out there. We need to stay in the right path. It's unfortunate that we're seeing, even during a pandemic, that there's so much political I don't want to say the word, but there's so much what going on when it's just sad to see, in my opinion, that that's more important than what's actually happening right now. But again, politics has taken over, and it's honestly a shame to me to see. But the good part is that the Fed is backing everything, and these true facilities that are being put together, they are being utilized, and hopefully they're going to come to their senses after the election and things are going to even out. That's what I think is going to happen. But what we saw yesterday is we actually worsened for the first time in 90 days. You can see that purple line, that 200-day moving average. We actually worsened below that. So that was a good indicator that rates may start to continue worsening. And why is because the market thought that we were going to get a stimulus. And now today, it looked very clear that we're not going to get it. So why? More volatility, move back into mortgage-backed securities. So this is a day in, day out. Like, we don't know what's going to happen. And that's the proof. We traded below the 200-day moving average, which is the biggest line of support that we have. And now again today, because of the news, we're now trading above all of our major trading averages except for the 10-day, which is that green line that we weren't able to break above. So now tomorrow it's going to be what's going to happen over the politics, right? What's going to happen over stimulus? And so this is a day, why I want to show this is because I want everybody to understand on this call that this is a day in, day out plotted course right now. It really is a plotted course. And nobody on this call, I can probably guarantee, knows what the course is exactly. But what I can probably see happening is that as we get closer to the election, what's going to cause rates to get better or worse is if we know who is going to be elected. Okay? If the more that it looks like we know who's going to sit in office, the less volatility you're going to see moving into the election and then after. Less volatility means higher rates. More volatility generally means lower rates. The other thing that we're fighting is even after we get past that is inflation. What's going to happen with inflation over the next 6 to 12 months? What's going to happen as a result of all this money that has been essentially printed to bail out businesses and bail out the economy? And those are things that we don't know yet, we just don't know them yet. But the forecast is definitely that rates will stay low. They will stay low, moderately low. And I consider low, you guys, a 3.375 primary residence purchase or a 3.5 primary purchase or even a 4.25 30-year fixed investor rate. Okay. But right now, with a 1-point buy down, okay, on a 4-unit investment property, we can get you about a 3.375% 30-year fixed. We can get you rates in the, close to the mid-2s on a purchase right now on a primary home. So are they going to stay that low? Probably not, but it's all based on volatility. It's based on inflation. It's based on I think a lot of it is based on who does get reelected and what things look like going into next year. Just as on the last call that we did, somebody pointed out, well, is the 10-year going to go down below 1%? And I was kind of like, it doesn't seem like it will. Just as that happened, it did go down there. So what's the flip side to this? The flip side is we could start trading off a 1.5% coupon. We could trade off a 1% coupon. At this point, I think anything can happen in regards to rates, But if you're looking to wait for that perfect moment, this screen should show you that you're already there. You just got to be working with a lender that has access to good rates, and anything you lock up in this market is worth it, So don't get stuck in the weeds and be super happy that we're getting these types of rates. It is a silver lining to what's going on. And anybody that was on that last update call that we did back in March, one thing that myself and Marshall Reddick pointed out was, hey, when there's blood on the streets, buy property if you're buying in the right market. Well, we said to buy in areas like Texas and areas like California, right? And obviously good markets of California. I think we said steer clear of Las Vegas may have been the only market that we picked on that we represent. And if you look at it, you guys, those markets have done very, very well. I think some areas have gone up as much as 15 or even 20%. So another thing to kind of think about too is what's going to happen when the interest rates start to rise again. What is going to happen to property values? And that's why it's so important to not just be buying for value. If you're an investor, you buy because the numbers make sense. Marshall Reddick has a phenomenal calculator on their website. I use it for my 6 investment properties. Every one of them that I've bought, I have gone on there and I have religiously looked at the numbers before I purchased that property. The properties that I own right now, I've actually bought since 2015. I have sold properties that I've owned before that. So all my properties I own right now, I've actually had the ability to use their calculator. And I live by that calculator. If the property cash flows, if the numbers make sense. It doesn't matter what the value is as long as you're going to buy and hold it. Because over a 10-year period, if you're buying in a really, really good market, like the markets that we represent, there's a very good chance that that value is going to be a lot higher. And you just don't ever want to have to sell in a down market. There are people, I guarantee you, that sold in, March, April, May, that maybe sold for a lower price because they were scared, and you don't want to have to do that. And if your property cash flows, then you're lucky. And so again, make sure that the numbers make sense and take this screenshot as a true understanding that these low rates are one of the only silver linings right now out there, really. Okay, now I want to just quickly talk about how rates affect cash flow, why they're so important. As you guys can see, every 1% increase in rate, so 4.5 to 5.5, is a 12% increase in your monthly payment. That's why rates matter. And I also want to point out, just real quick, 4.5%, 5.5% are great rates. You can make a property work just fine, up to even a 6.5% rate. You just got to put more money down to get that cash flow, okay? But you're deducting your interest against your cash flow, right? You're deducting these expenses because it's essentially a business that you own, right? That's what real estate is. So we just love to be able to take advantage when they're this low, right? But you can buy property over a 20-year period in any market. You just don't buy too much too fast, right? Buy property every few years. Do it right. Make sure the numbers make sense. Buy in the right markets. Get great property management. That's one of Marshall Reddick's claim to fame, is they become the best property manager in the nation. So have a good property manager, and then just sit back and go on autopilot, and focus on your income at your job and on your families. And before you know it, your properties are halfway paid off. They've gone up in value, hopefully, because you bought the right areas. And then you can 1031 exchange those properties into newer properties, right? Or into bigger units, right? So you get more cash flow. And another thing is, if you're young, focus on buying A-class properties. Buy in markets that maybe they don't have as much cash flow, but the $200 a month positive cash flow is not going to change your life. What will change your life is if that property doubles in value in 20 years. And then you can sell it and 1031 it into cash flow, right? So this is a great time to buy A-class property because rates are so low, And I have some other great examples of homes that I bought that are A-class that I can talk to you about. One of them's in Bee Cave, Texas. I paid $570 for this property. And even the owner of MR was like, "Why? This is much higher than we normally go." But I was convinced the market was great. And I rented the property they rented it for $32.95 in a week. And I had a 2-year tenant there. And now I can raise that rent in that market to $3,700. And that property barely cash flows at $32.95, but it does cash flow. And it's in an A-class market in Bee Cave, Texas, and that property is now worth $640 or so, and I bought it at $570 about a year ago because I bought an A-class market. So depending on your age, depending on your amount of capital, that's what Marshall Reddick's value is they can help you to plan that all out based on your age, so you can get to that end goal. Just real quick, you guys, we have a weekly market update, goes out every Saturday. It's great information. It kind of takes a lot of the news and what's going on out there and puts it all into one. I write some of these, some of them I don't. It really just depends on what happened that week. But all the information is just phenomenal, and it goes out free every Saturday. And so we usually add everybody onto that. So everybody that is on the call, we will add you onto the market update. If you want to opt out, go on ahead and opt out. It's totally fine. But just be aware that we're going to add you on there. And this is the market update, goes out every Saturday. And you guys can always call me with any questions. Just a little bit of information about my company and just why CMG. One of the largest privately held mortgage companies. We have one owner. We have the ability to make decisions very, very quickly. We're licensed in all 50 states. We are a purchase lender. We do a ton of refinance business, but our bread and butter is purchase and the ability to close fast. We have bank rates with lender service. That is one of the main reasons that I came to CMG. Is I was with a direct lender before that was a great company, but they weren't licensed everywhere. They were only in about maybe 15 markets, 20 markets. And frankly, just their interest rates were just I just got tired of getting, beat out by everybody that was a big bank. Bank of America, Wells Fargo, I was constantly getting beat. And so coming to this company, I've got a very moderate compensation plan, but I'm able to keep a lot more loans and I'm able to build a lot more relationships. So I've got bank rates, but with lender service, right? With the fastest execution possible. Also, this company specializes in investment property financing. Whereas many other lenders right now don't want to do investor, we welcome it. Okay. Also, the all-in-one program. Any of you guys that have ever heard of the all-in-one, it's our proprietary product. We created it. If you guys want to Google all-in-one and learn more about it, you can reach out to me. I can get you guys, an orientation on that. It's a great, great product. It's basically where you can tie your bank account to your mortgage and pay off the property faster because the amount of balance you have in your bank account goes towards your interest. So we actually did create that product. Chris George, the owner of my company, created it. And it's a phenomenal product. So if you want to know more about that, just reach out to me. And then lastly, we're a loan servicer. Another reason why I came to CMG. I got really tired of giving people a great loan process for buying the home, but then afterwards, your loan's getting sold to two different companies. The servicing gets transferred. It's really a pain in the neck. Whereas here, we're focusing on making the client experience for the actual 30 years that you're going to be making that payment. We are focused on making that, an amazing, amazing process. And Chris George, the owner of my company, today on our chairman's call actually said, he's like, look, like servicing in the industry is difficult. It's not good out there, and we are one of the best out there, and even we kind of suck, and we want to get better at it. So their goal for the next 12 months is to become the best loan servicer out there. They started off their servicing portfolio last year with $5 billion. Right now they've got 27 or so, and they're going to end this year out with about $32 to $33 billion in servicing. So they are trying to get their clients right now in the door and keep you guys happy for the future. And I love it because when I do 5 loans for you, they're all going to be with CMG. You log into one online account, all your loans are right there. And that gives me more control because if you have a problem or maybe the taxes accidentally didn't get paid, because sometimes servicers mess up on that, and that's why you always got to check on that stuff. You guys can call me right away and I can check in with servicing. It takes me a minute. It's one email, So that gives me more control to give you guys a better experience after you buy. Just a little bit about me and my team. CMG's got, I wish I had 2,387 5-star reviews, hopefully one day, but me and my partner, we've got, over 150 5-star reviews on Zillow. We're on Testimonial Tree. There's a lot of information on us online, all verified reviews. So definitely check us out. But yeah, a little bit of info about that as well. And this is all my information. It's been really, really great talking to you guys tonight. I hope that you guys got some great information. I truly wish all you guys the best. Again, praying for safety for everybody on the call. And just, again, you guys get in touch with me with any questions. And it's just been so great to be here tonight. Thank you, Vince.
Thanks so much, Reed. That was a ton of awesome info. We do have some really great questions, but what we're going to do is we're going to direct those, being that some of them are pretty specific. So I'm going to be following up with you folks tomorrow and through the rest of this week to get in touch, see how I can help, whether that's questions that I can help answer or, just get you directly connected with Reed to answer more specific lending questions, then we will do it. So this is my information as well. Feel free to jot that down. I will be doing some follow-up and we will go from there. So we appreciate you guys all hanging in there with us tonight, and I hope you guys learned a lot. Reed, thank you again so much. It's always great to have you on, and look forward to the next time.
Thanks, you guys. Bye.